Good afternoon. This is Gene Inger with a very brief noon hour, 12:30 comment for our MarketCast members. I'll look at these charts again tonight, of course, on the IngerLetter.com daily briefing report. But for now, intraday, I want to show you the daily chart only because of the proximity to the break of the mid-December low. We call this broken seasonals through December, where we expect an early rally, a drop down, bump up, and then further decline, and called all month long for the market to run into a brick wall of resistance at the beginning of 2008. Our position short guideline continues all the way from 1595 forward rolled from the December to the March S&P contract in harmony with our bearishness, which we first started talking about in late 06, but felt we would get rotational topping sector by sector aspects during 2007, and then come on down as this market evolved, and as many stocks had in fact their distribution masked by the behavior that we saw by the cover of a strong Dow and S&P. Here intraday, we continue with the guideline short at or as close as you could get this morning on the first little push-up into that brick wall of resistance for 1479. Now we have a 5-point trailing intraday stop guideline period, which certainly has not been attacked. It may be. If it is, we'll by one tick above the round number, we'll go long, trailing a 1-point sell stop reversal and 2-point autopilot, as IngerLetter.com members are familiar with what that means. Currently intraday, the Dow is off 207 points from the get-go today, suggesting we would be down 100, 150. We were still slightly on the upside at that time, and indeed, maybe a chance of a 200-point decline. We've got that. I don't want to go so far as to say crash alert on the first trading day of the new year, but you know my view of this. Chinese water torture for the past year, making it very hard to be short or to trade puts unless you nailed it just right, as we did on a couple of the spikes. But indeed, generally speaking, very hard and very high premiums to try to play it with puts or to stay short throughout, though we have done so and represented that with our S&P now adjusted 1595 short sale, having been almost alone, my goodness, in April, May, talking about a liquidity crisis and credit crunch forthcoming and calling for the rally into the July, even though we felt it would not be sustainable. Currently, the Dow's down 210 points. Again, as we look at the Dow also on a daily basis chart, unlike the S&P, here the Dow, I think, is leading with the weak financials and, of course, the oil scenario, which just hit 100. We took out the low of mid-December. The next goal will be the November low, and I see no problem in seeing that achieved. As I said for January, brick wall, down, up, down pattern, and then we'll see whether we get it up into the beginning of February, but not necessarily persisting much beyond. There is risk of a melt away to the downside occurring now. Of course, we'll assess that, and I'll come back on my next remark ahead of the 2 o'clock balloon, and we'll take another look at that here intraday. NASDAQ currently off 51 points, breadth negative by better than 2 to 1 on the New York, breadth negative by about 2 to 1. The NDX is down 25 points. I'm going to look at the daily charts here to put this in perspective, and we forecast from here that this gap would be filled, then some rebound, then we'd fill this little gap, continue down, take out this general rising bottoms pattern, and continue declining in harmony with our expectations. Semiconductor index, others have been jumping on these techs. We said, no, they're too commoditized, they're heading lower. We love some of the stocks, but not yet, and we will indicate here at IngerLetter.com when we think that time has arrived. The dollar, we called for rebounding price behavior, but now I think there is some risk of trying to break the recent lows and take the dollar a little bit lower on a short term. If they take it much lower, the ramifications are rather significant, as you know. Bonds are up 1.18 as rates drop, and thank God the Fed didn't cut rates more like some of the screaming banshees wanted them to do, shall we say, seditious, if not treasonous, extremist globalists, because indeed, had rates been cut more, rates would have gone up significantly, not down. And as we saw, 100 basis points was like pushing on a string, as we forecast would be the case. In this scenario, Again, we are not anti-globalist trading. We're against anti-stupidity trading. Just because we want to be supportive of free and fair trade doesn't mean we have to be everybody's fool. Crude oil, we've been bullish on this, called for the move drop down to 85, 87, and then back up. And now as it hits 100 on the front month, here we're looking at the March, which is just shy of that at 98.75. We think it's going to go actually over 100. Well, people keep saying this is impossible, and you know what we think happens later on. Oil index is up a fraction. Gold's up $22. Again, that's the argument of the U.S. currency becoming a fiat. We don't have time to look at many individual stocks. Little tiny Pure at 685, down 14 cents, has been acting beautifully. We think that this is going to be an interesting year for it as a small speculative domestic centric stock that is disruptive in its field, as you know. SanDisk is another that we're keeping an eye on, do not own, have been warning about for some time. Others are jumping on it, and we said no, we think it can actually continue lower, and it's doing that. Merrill Lynch, we've been bearish on since the 90s, and indeed it's in the low 50s. We think it's going into the 40s. That does not mean we'll be a buyer of that, even though we said we would take a look and consider it at that time. Goldman Sachs down $6 today, had handled the whole situation better, but they too can go down. JP Morgan Chase has heavy derivatives. We have been thinking for some time that it too can work lower. And Citigroup, for many months, we've called for this to be a sub-30 stock. It is. Now the question is, where is the bottom? We don't want to catch a falling knife. We think it's stupid to bottom fish in this sector. For now, there will be plenty of evidence of when a low has been made. And Intel, down 144. We have also suggested what would be heading down most recently, even though we like the stock very long term, it was certainly ahead of itself. And Apple Computer, which we wrote up at $12 a share and has hit the 200 area, we think is a fine stock, great growth, consumer products company of our generation. But, as I've mentioned last week, I thought it's ahead of itself and can be subject to pullback price behavior with in harmony of very long-term higher prices. And Google, I wouldn't touch for a 10-foot pole, with a 10-foot pole, no matter what it does in here, even though I think Google, too, has further possibilities in the very long term. But in the shorter term, I think that is a distributional pattern. Good afternoon. Down, up, down. The pattern expectation, as we discussed, back later. Cheers.